All right, good afternoon. Thank you very much for that introduction. My name is Mark Randall. I run the indices team at the JSE. I've been doing that particular role for about 3 or 4 years. So I have the great pleasure of talking to you about indices. It's a topic that hopefully will interest you a little bit. It interests me a great deal, I must be honest. So if we get to sort of 3 or 4 hours down the line and I'm still giving you pages and pages of numbers and charts, then please stop me and say, this isn't interesting anymore. Give me something interesting. But we'll see how we go. All right. I think just on the questions, if you have any particular questions about maybe one of the slides that I put up, something that I haven't explained properly, I think maybe you can stop me then. We'll pick that up. But any sort of conceptual questions or broader-reaching questions, let's leave for afterwards. You feel free to ask me, and don't be offended if I say I'm not going to answer that now. I'll answer it later. Please just remind me later. All right. Maybe before I get going, can we just see by show of hands, was anybody at our presentation last month? Or are we all here for the first time for this presentation? That is fantastic because my slides are the same. At least the first half of them. So none of you will be bored. So let's go. All right, this is what I want to cover this afternoon. 5 sort of simple questions. The first one, what is an index at a very broad level? I think this is it's something that you probably hear of quite often, so I just want to give you some of the core principles behind indices. Who does what is an interesting one, and that's really about this whole sort of financial services structure that we have with all these different firms that do all sorts of different things. So I'll just spend a few minutes of talking about who the different role players in the industry are. Basically, when something goes wrong, who do you want to phone and who does what? I'm going to spend a very short time on index basics, what to look for in the rules, some of the things that we consider when we construct indices. I'm then going to spend quite a bit of time on some SA sector indices. So every month we pick up a different set of indices. Last month we did the top 40. This month we're going to be doing SA sector. And then questions obviously will hold for the end. All right, let's jump right into it. What is an index? This is actually something that's really, really, really simple. I think you may have heard of indices. You may have seen them on the screen. You would have heard of CPI, Consumer Protection Index, Price Index rather, Consumer Price Index, and a whole bunch of different things. At the end of the day, an index really is a basket of goods. So if you consider you walk into your Spar, you pick up 1 liter of milk, 1 loaf of bread, Sasco in my house, we're Sasco fans, and let's say 18 eggs, free range I hope. Put them all in your basket. You've got 1 of each. You go to the till and you pay, let's say, 55 Rand for those things. That thing you can see as a price. Now, if you go the next month and buy exactly the same 3 things, 1 loaf of bread, 2 liters of milk, a box of eggs, and you pay 57 Rand for exactly the same 3 items, you can start to make some kind of conclusion about price levels, so to speak. So that basket of goods has increased in price over the period. All right, now obviously nobody's going to go into Spar and buy exactly those 3 things every month, month in and month out, but as a model that represents average price levels, it can be useful. And that's exactly what CPI is out of interest. So what the Stats SA has done is picked a basket of goods that they say is indicative of the South African economy, 1 of this, 1 of that, 2 of those, etc., 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 and they track those prices month in and month out, and that basket of goods increases in price, never down unfortunately, but increases in price over time, and they publish that number as an index. When we get to the financial world, to capital markets, it is exactly the same thing. So all an index is a set of securities, a set of bonds, a set of assets, maybe gold, maybe there are commodities in there. It's a set of things, a basket of things, and all we do is we work out an average price for those goods and we publish that price. And at the end of the day, that's all an index is. Now, the beauty about indices is that First of all, anybody can do it. I mean, we happen to publish indices for a living, but you can do this in your own home with Excel. You can use any kind of tracking software to do it. You can pick a basket of securities, work out a price over time, a portfolio, if you like, a notional portfolio, and track it, and that is an index. So you can make your own indices. Obviously, we do that for you, and we've published some indices. There's several index providers. The JSE is one of them, but there are others operating in the country. It's not a monopoly or regulated in any way. Anybody can work out this price. And really some of the benefits, or not some of the benefits, rather some of the questions that you need to ask, obviously, is what stocks are getting picked for a particular index. So you can pick one index up, the top 40, for example. There are a few questions you're going to ask. What is inside that index? What are the 40 stocks? What are the rules that go into making that thing? And then secondly, how do you calculate the average? And there are different formulas that we use for calculating that average price. It can be equally weighted or market cap weighted, and we'll speak about some of those. I think one of the key questions is, why even bother? Or, why even do this? And the answer is that there's a couple of reasons. So, I mean, the first one is, if you think about the JSE, for example, we've got, 400 listed instruments on the exchange, equities that you can buy. There's over 1,000 bonds you can buy. There's single stock futures. There's all sorts of different things. So if you now look and say, all right, now what instruments went up today and what instruments went down, and you'll end up with a pile of 600 on this side and 400 on that side. And then you say, well, is that good or is that bad? Did the market go up today? What does that even mean? So an index gives you a barometer to say, I can start telling you something about price movements over time. The market has gone up today because the basket of goods between yesterday and today has gone up, just like in your trolley. So that's one reason. Another useful reason for an index is to say, well, if you go and give your money to an active fund manager, or you invest it in your cousin's car business, or whatever you do with your money, and you get a return of, say, 10% per year, is that a good number? And it's very difficult to answer that question because it may feel like a lot of money, but is it good? And the only way you can really truly answer that question is if you compare it to something. And that's when index comes in. So, for example, we create an AllShare index, which has got the top 99% of all of our companies in that index. And that's a very good market barometer. If you want to compare your performance of your portfolio of equities to something, the AllShare index is a very good measure to do that. So if you've got 10%, but the AllShare index returned 15% over the same period, you probably want to look for a new investment advisor. Okay, or unpack exactly why that happened and what were the risk factors and why were you different from the index. Okay, so it's useful for that. The third useful point about an index really comes back to the sort of metaphor of a basket of eggs, in that if you decide, all right, I think in South Africa banks are going to do well. I've done some research, I've spoken to some people, I've looked at the economy, people need to borrow. I think banks are going to do well, so I want to invest my money into the banking sector. Now, option one is to say, all right, I'll take all of my money and I'll invest it in one bank. Now, if you pick FNB, for example, that may be good. If you happen to have picked African Bank, not so good. All right. So as soon as you're putting all of your money into one instrument, you run the risk of something very specific happening to that company. That's got nothing to do with the entire financial sector or the entire economy. There may be a problem with a director. They may have had a failed business. There may be bad debts. Whatever the case is, individual companies fail or do badly. I mean, they don't have to go bankrupt, but they could just do badly. So if you're investing in a basket of things, what's going to happen is those individual problems in one company will be offset by the equal and opposite effects in other companies. So, for example, if one company does badly, let's say MTN does very badly, you may find that Vodacom picks up because all the customers move from one to the other. So if you've got a basket of these things, you tend to, I suppose, diversify that very specific risk by putting all your money in one basket. Okay, so that's one of the other benefits from an investor, is you get this exposure, this diversification, without having to go and pick individual stocks and decide how to allocate your money. Of course, there is a saying about don't put all your eggs in one basket. So I'll leave that with you. I thought it was a good metaphor. All right, let's move on then. Let's talk about the system. Who are the role players? Who does what? And I've put up sort of 5 key ones here. And I think at the very top is the marketplace. So the JSE at its very core business is a trading platform. We provide a marketplace for buyers and sellers to come together and sell instruments, whether that's equities or bonds or derivatives, whatever that is. That's really our core business. That's a highly regulated environment. There's an act that governs what we do. There's all sorts of investor protections, FSBs involved, that sort of thing. So it's quite a tightly regulated environment. Okay, so any stock that trades, if you want to sell or buy one Anglo share, you can only do it through the exchange. And even more so, you can't do it. You have to go to your broker, who's a registered member of the exchange, who's got a separate legal capital entity that they trade through so that they can guarantee your trades. You have to go to him, and he will do the trade on your behalf. So there's this whole sort of trading environment of how you get your trading. And even when you're trading, if you're trading online, there's still a broker that's doing the work. Your trade has to go through a broker in order to get to the exchange. All right. At the end of that, then every day we get a price for every instrument. So for our 400 or 600 or 1,000 instruments, we get a closing price for every instrument. Then the index calculation agent comes along and says, all right, now that I've got all of these individual component prices, my basket if you like, I can now go and calculate the average price for the index. Okay, so that's what the index calculation agent does. There's a lot more to it than that. I mean, we have to follow the rules, and we do R&D, and there's all sorts of things that you don't really need to know too much about. But at the end of the day, the index calculation agent is an independent party who's responsible to publish that number every day. So when you see on the TV that the top 40 closed yesterday at, you've caught me now, 38,000, give or take, whatever it was, that's the number would come out of my team. All right. Then we have an index tracking fund. So this is normally an asset manager, an investment bank, that sort of thing, who would put together a fund, normally some kind of unit trust structure or ETF structure. And that would be a pooled fund where they would say, all right, what we're going to do is we are going to take money from lots of people, lots of investors. So we'll take your 100 Rand and your 300 Rand and your 10,000 Rand. We'll put them into a pool. And what we'll then do is we'll go and take that money and we'll invest it in the stock market. The question is, what do you buy? Now, in the traditional model, that company would be an asset manager, and they would go and pick which stocks that they think are going to do well based on whatever metric they're using. They may have a style approach, a volume or a value approach, or a growth approach, whatever that may be, and they would go and pick individual stocks, and they would take your pool of money and invest that fund in those stocks. And Mike will speak a little bit about the historical performance of those kind of managers, which you call active fund managers, versus the passive manager, which is an index tracker. So what the passive manager does is says, okay, I'm not going to make any decisions. All right. All I'm going to do is I'm going to take your money, I'm going to take the index data that the JSE gives me, and I'm going to invest your money according to that rule. So let's say, for example, if you go back to our basket analogy, there's, you know, 1 box of eggs, 1 milk, and 1 bread. We'll say, all right, we'll take all of your money and we'll buy 3,000 eggs, 3,000 milks, and 3,000 breads. Exactly in the same ratio that the index provider gives you the instruction for. So my job as index provider, I say this is the top 40 index. It's made up of these 40 companies today, and these are the weights of each individual company. The fund manager then says, all right, thank you, JSE, for giving me the weights. Thank you, investor, for giving me the money. I'll invest your money in these weights, and you will then get that return. The benefit of that is you get instant diversification with a very, very small initial investment. Because if you were to go and buy all 40 of the top 40 companies, you need a very big initial capital outlay to get that, because all the stocks obviously cost a lot of money and you need a big pool of cash to get that. By pooling your cash, it's easy for the asset manager to get those in the right quantities. All right. Also, the index tracking fund is also quite tightly regulated. So what we see in an ETF environment or unit trust environment, that your money as an investor is completely protected, it's ring-fenced. So the asset manager can't go and spend your money on, you know, a trip overseas or a new yacht or whatever it may be. They are required by law to invest your money into those assets as defined by the index. And there is some quite tight regulation around that. So you do have a lot of protection as an investor that your money will be used for what the asset manager says it will be used for, which is very important because obviously you don't have full transparency in that process. All right. The next step is the investment platform. So now you can imagine we have lots of indices. The JSE publishes around about 160 indices every day. But if you look at the total number of unit trusts or ETFs or that sort of thing, there are hundreds of different of these funds that are doing different things. So Mike will talk about the ETF world, where there are a large number of ETFs that you can buy. And now you have exactly the same problem, because I've just said, well, okay, which stock do you buy out of the 400? I said, don't worry about that, buy the index. But now I'm telling you there's 100 different index funds. So which one do you buy? So, you know, as that variety gets bigger, it means that you still need to do a little bit of research to find out which one to buy. But my point is you don't have to buy just one. So you may say, all right, I want some of my money in the top 40 because those are nice blue chips. That's going to be fairly low risk as compared to other equities. So I want some of my money in the top 40, but I also want some money in mid caps or small caps and some in the income fund, et cetera, et cetera. And what you would then ordinarily have to do is go and give each asset manager a little bit of your money. And if you then wanted to move out of the top 40 into the mid cap, you'd have to give an instruction to this asset manager, sell that fund, get your cash back, give it to this guy, buy. And that's exactly where the investment platform comes in. So Mike Brown, our second speaker, is going to be speaking about his platform called ETF South Africa. And what they do is they give you a one-stop shop access to all ETFs. So basically you have one account with the investment platform. You can then say, all right, I'll give you 300 in the month. This month, put your money into that ETF. Next month, put into that ETF. It's easier to swap between them. It just makes life a little bit easier. And then finally, I think most important in this whole chain is you, the investor. Obviously, without your money, nobody has anything. There is no business. and obviously the whole structure is here to help you save and invest. I think what's probably the most important thing as an investor is keep asking, keep learning, keep reading. At the end of the day, it's your money, it's not my money. At the end of the day, you're ultimately responsible. You don't want to give away accountability for your money. So make sure you understand where your money is going, into which products, what are the risks, what are the factors, what are the structures behind that. All right, very, very briefly here, some of the questions that we look at when we do index construction, and if you see a list of ETFs, each one will be based on a different index. So some of the questions you need to ask to understand that product is, first of all, what asset class is in that index? So you may get an index that just covers commodities, maybe some gold in there, some silver, some platinum, for example. You may get an index that just covers bonds or just covers equities, and each different asset class will have a different set of risk characteristics, and it's important to understand those. So the first question you want to ask when you look at an ETF is what asset class is inside here. The second one in the yellow is, how do I pick the basket of goods that goes into that index? Do I take the 40 biggest companies? Do I take ones that all have the same sector? Do I take ones that all have a high dividend yield? And there'll be a rule for each index that says how do I pick the ones that go into it. The blue then is the weighting that says once I've picked my companies, how do I work out this average? Is it an equally weighted average? Do some count more than others, et cetera, et cetera? And then finally, each index will have a set of rules. There's some new regulation coming out that requires all index rules to be published, available to you for you to see. So before you go and invest, make sure, insist at least that you can see the rules of the index or the rules of the fund, and go through those. Sometimes they're a bit complicated. I mean, our document is quite a thick one, and there can be a bit of legalese in there, but it speaks about treatment of corporate actions and reconstitutions and selections and that sort of thing. But it's important to know that there is a set of rules so that you can hold the provider accountable to that. All right, I'm going to talk very briefly about our equity indices. At a high level, we've got a few different types. We've got market benchmark indices, so the top 40 you would have heard of, the mid-cap maybe, our property index, our pref share. Those measure, I suppose, asset classes. We then have some style indices that you'll see in the documentation, so a RAFI index, there's a dividend plus index, a rand hedge, and so on. There's some foreign benchmarks, so you could get an index that covers European stocks or Japanese stocks. And finally, today I'm going to speak about the sector indices, which look very, very specifically at resources, industrials, and financials. All right, so what is that? We offer 3 indices that I'm going to speak about tonight. There's a RESI 10, which is the 10 largest companies that are classified as resources. The Financials 15, which is the 15 largest financial companies, and the 25 largest industrial companies. And this is a classification system that goes back probably 30 or 40 years, or a bit more maybe. So it's something that stayed with the JSE. And the classification is done according to where each company earns its revenue from. So any company, if you look on the left, the resources, that is either an oil or gas producer, which is effectively Sasol, or any mining company would be classified by the JSE as a resource company. And most of their income is earned either through mining or oil and gas. And you can start to see that we would expect those kinds of companies to behave the same way. They've got the same sensitivities to macroeconomic factors, to the law changes, to the legal environment, to global demand, that sort of thing. And it's interesting to put them all into the same basket so you can measure a very specific thing. Financials is what you would expect, so it's banks, insurance companies, financial service providers, property companies are in there. So those would be property development companies that would go and buy, 3 shopping malls and rent them out to people, financial services and real estate. And industrials is effectively everything else. So anything that is not a resource or a financial, we just call it an industrial. And that's a very broad bucket. So you'll see there's telecommunications, there's tobacco, there's retailers, there's healthcare, there's media. Everything that isn't one of those first 2 things would fit into industrials. If we look at our AllShare index, which is the 99% of our largest companies, and we sort of have a look at those 3 sub-indices, the RESI 10, the FINI 15, and the Indy 25, you'll see it's very interesting how much of the full market that it covers. So our RESI 10 index covers 23% of the entire AllShare index. Even though it's only 10 companies, it's nearly a quarter of the entire market capitalization of the JSE. And that really speaks to the historic importance of resource companies in our market. It's diminished over time, but a lot of the economy was built on mining companies, and that speaks very much to that. The financial, those 15 companies in that index form about 15% of our full listed universe of stocks. These 25 companies, the biggest 25 industrials, are about half of all the listed companies. And then the remainder, everything that's left in the AllShare, is 13%. Now, when we talk about weights, there's a distinction between the number of companies, because in this entire all-share universe, there's around about 160 companies that we stick in there. All right. So 160 of the companies are in there, and obviously there's only, 50 that form this full 87%. So there's 110 companies in that little segment. And the reason those weights don't really tie up is because when you look at weights, we don't give everybody an equal weight. We say a company that is bigger in terms of market capitalization, and market cap really says, if I were to go and buy the whole company, if I were to go and buy every single share issued by that company, how much would I pay for it? And that's the market capitalization. So a company with a very big market capitalization has got a bigger impact on the economy, a bigger role in the economy. There's more trading activity than a company with a very, very small number of shares or very small market capitalization. So what we do is we put the bigger companies into the index, and the smaller companies then make up the remainder. So that's why when we pick these top 10, it's the top 10 based on size, and the weighting is based on total size. Just to give you a sense of the numbers, so there we go. There's our breakdown again, resource, financial, industrial, and then the other, and the other is 109 companies. If I just skip the slide, I wouldn't have to do it in my head. So let that be a lesson. Market cap is the total size of the market segment represented by that index. So in our all-share index, we currently have about 9.3 trillion rands worth of market capitalization. So if you wanted to go buy the all-share index, if you wanted to go buy every listed company in South Africa, that's how much it would cost you. My piggy bank isn't that big. Maybe yours is. I hope so. You can send me a commission check if it is. If you look at the breakdown, our RESI 10 index covers 1.6 trillion rand of that 9.3. 1.4 for financials, 5 trillion for industrials, and then the remainder sits in that not applicable. There's 109 companies, and they are the same weights again. All right, you've been waiting for a graph the whole presentation, and here it is. When I joined, I got very specific instructions. You're not allowed to do an index presentation unless you do a graph. So this presentation is a bit lighter on graphs. I hope you'll forgive me, but I do have one at least. What I've given you here is the historical performance of those three indices back to June 2002, which is when these indices all started. So it's about 12 and a half years or so. This performance says if I invested 100 Rand at the end of June 2002, how would that money have grown over time? Now, the first important thing there is it assumes that all dividends are reinvested. So any equity will generally pay you dividends either once every 6 months or once a year. This index performance assumes that you go and take those dividends and reinvest them back into your portfolio. You don't pull them out and go and spend them on overseas holidays or yachts or food or whatever you spend it on. Okay, so that's the first important thing, is all income is reinvested. The gray, is it gray? Yes, the gray line is our all-share index, which measures the 99% of basically the whole equity market. And you'll then see the relative performance of those three different sectors. So the yellow at the top is the industrial companies, the blue financials, and the green line is the resource companies. Now, different people will look at that graph and think different things. So you may say, well, all right, there's my resource line. It's done substantially worse than the other two. Therefore, it has to go up. That may be one approach. Or you may say, listen, this thing has done so badly for 4 years, it is never going to do well. I don't want to put my money into it. Now, what's nice about those two approaches is that depending on exactly where you think the market is going to go, depending on what you think is going to happen to resource companies, you now have an investment tool that you can go invest in all resource companies by buying one fund, one ETF, one unit trust, whatever you buy. So you can get access to that blue line, the green line at the bottom, by buying one instrument. You don't have to go and buy all 10 resource companies. In the same way, if you think, all right, industrials have done really, really well, I think they're going to keep doing really, really well because of whatever reason, you can get into that market by buying one ETF. So that's where the benefit is of saying, all right, I can now start making calls on different sectors of the economy, and I've diversified away that specific risk of depending on one egg. I've got rid of that because now I have 15 or 25 eggs in my basket. But I can still get the same diversification, but only buying one instrument. All right. So that's where the index really comes into play. For interest, for those of you that like these kinds of things, and it won't be everybody, here are sort of some of the standard metrics. So if we look at the AllShares, the RESI, the India, and the FINI, the annual return on those indices over the last 12 years, the all-share index has returned around about 17% return per year. That's with dividends reinvested. which is obviously far better than you're going to get in your money market fund. The industrials, the yellow line, got 22% annual return over 12 years sustained, and the resi line, the bottom one, got 10% a year, still far better than cash, better than inflation. So even though that green line at the bottom may look bad relative to the rest, if you think it's going to go up, or even if it doesn't, it's still beaten inflation, it's still beaten a lot of other things over that period. All right, one question obviously is how much can you lose? So you would probably know that equities are not a one-day game, generally speaking. If you're investing for the long term, you're generally going to follow some sort of buy and hold strategy, at least if you're in ETFs. So how much could you have lost? And what this thing measures, the maximum drawdown, is the worst case scenario. If you were the worst possible investor, if you bought at the worst time and sold at the worst time, you followed the wrong advice, how much could you have lost over this period? And if you go back to the graph, there's our global financial crisis, 2008, 2009. We're saying if you bought resources there and sold them there, first of all, you would have been very grumpy with yourself. And secondly, you would have lost 52% of your investment. So in other words, if you bought 100 Rand there and sold it off there, you would ended up with 48 Rand. Okay, and that obviously you'll see there aren't a lot of dips over 12 years. I mean, this is not a weekly event, but equities do run the risk of that kind of market correction. Okay, on the bright side, if you do the same thing for resources, if you invested 1,000 Rand once off back in June 2002, you would today be sitting with over 3,000 Rand. If you invested 100 Rand every month since June 2002, you would today be sitting with 28,000 Rand. Okay, so over time, you'll see it washes out, but there are short-term corrections. There's a possible of losses. The graph goes up and down, and you need to be aware of that. I'll talk for a few more minutes. So that's at an index level, what kind of performance you can expect. I want to go back now to our set of individual eggs to say, now, if I buy this RESI 10 index, what exactly is Satrix or RMB or ABSA doing with my money? All right, how are they investing it? So what I've given you here are the constituents of the RESI 10 index at the moment and their current index weights. This kind of data will be available on any fact sheet. So if you pick up the fact sheet for an ETF, this kind of data will be on there. So I encourage you to go and look at it. What it means is the following. The biggest weight in the index is BHP Billiton, a global diversified mining company, and the current weight in the index is 43.5%. That means for every 100 Rand that you invest in this ETF, ABSA will go, or Barclays will go and spend 43 Rand 50 on BHP Billiton. So it says what percentage of your money is going into each individual one of those 10 stocks. And you'll see that the big companies are at the top because they have a large market cap, and the smaller companies are at the bottom. And that's how the market cap weighting works effectively. And I'm showing you this one first because the RESI 10 is a particularly concentrated index. It's got a very, very high concentration of BHP Billiton at 43%. It's in fact quite abnormal compared to a lot of our other indices. And that really reflects the reality that BHP Billiton dominates the resource market. So if you were to go and buy all of those shares, it would cost you twice as much as if you had to buy all of Anglo-American shares. So BHP Billiton is a much bigger company than Anglo-American, therefore more of your money goes into that individual counter. Okay. To compare to the Industrials 25 index, I've just given you the top 10 biggest companies here, and you'll see that these 10 together add up to about 83% of the index. So these 10 companies out of the 25 dominate the index, and the other 15 are then only about 17% on top of that. And you'll see the concentration's a lot better. So SAB, again, if you invested 100 Rand, 18 Rand 70 would be spent on SAB, 14 Rand on Richemont, and another 14 Rand on Naspers. And that's how your money would be allocated. So you see you're immediately getting this diversification effect. Your money would go into each of these individual counters. And finally, the financials, which as you can guess is mostly dominated by the banks. So Standard Bank at the top, you'll see First Rand in there, Barclays, Nedbank, and RMB. Two property companies, so Growth Point and Into Properties. Into is a UK real estate company, so you get some international property exposure, and Growth Point is a local company. Sanlam's in there and Old Mutual, so you get the life insurance exposure as well. So I think my message, and I'm not too worried about these numbers individually, but when you pick up to say I want to invest in this index, you need to look at a few things. You need to look at this to say, where's my money going? All right. Then at a high level, what are the index rules? What is it measuring? Is it measuring financials or big companies or small companies or risky companies, whatever that is? And then it is very helpful to look at this kind of graph for your performance, and not necessarily, the trend as much, because we wouldn't expect past performance to be carried on into the future. So we generally say you can't use past performance as a prediction for future performance. But what is generally interesting is the spikiness of the graph. So the more spiky the graph, the more volatile it is, the more ups and the more downs. So if you're investing for very short term into a very spiky or volatile fund, you run the risk of losing a lot of money or gaining a lot of money. Whereas if the line is more flat, and if you see a cash line, for example, a money market account will end up much lower, but it will be effectively a straight line. So there's no risk of loss, there's no downside. You get your 5% every year reliably without any risk. So if you need to pull your money out next year to buy a car, a house, whatever you need to buy, and that happens, you have a serious problem. But if you're investing for your children's education and you're investing your 100 Rand a month or 1,000 Rand a month and you've got a 20-year window, then you don't want to get the money market return. You want to get the bigger return, and you don't mind the corrections over time. All right, let me leave you with my details.